A legal bombshell just dropped, and it could completely upend not just the market, but the entire foundation of Trump's economic playbook. What if the multi-trillion-dollar trade war, the endless headlines, the supply chain chaos, what if all of it was built on a house of cards, and a federal court just blew it over? That's not hyperbole. We're going to break down exactly what this means, how we got here, and most importantly, how you can position your portfolio for the seismic shifts that are coming. This is the kind of story that creates fortunes and wipes them out. The U.S. Court of Appeals for the Federal Circuit, in a landmark 7-4 decision, basically told President Trump that his favorite new toy for slapping tariffs on the entire world is, well, illegal. The heart of the issue is a law called the International Emergency Economic Powers Act, or IEEPA. This 1977 law gives the president some pretty beefy powers during a national emergency, like freezing assets and imposing sanctions. It's a big stick. Trump, in a move of creative legal interpretation, decided that the power to regulate imports under IEEPA also meant he could invent new taxes or tariffs out of thin air. He used this to roll out two massive tariff programs in 2025. First, you had the trafficking tariffs in February, targeting China, Canada, and Mexico under the pretext of fighting drug smuggling. Then came the big one in April, the Liberation Day tariffs, which slapped a baseline 10% tax on pretty much every country we trade with, plus an extra reciprocal tax on nations with a trade surplus. But the court looked at this and said, hold on a minute. Their logic was simple. They pointed out that the power to tax the power of the purse belongs to Congress. It's one of the most fundamental principles of the U.S. government. If Congress wants to hand that power over to the president, they have to do it with crystal clear language. We're talking words like tariffs or duties. Those words are nowhere to be found in the IEEPA. The court basically said the power to regulate and the power to tax are two completely different animals. You can't just regulate something by taxing it into oblivion without explicit permission from lawmakers. This lawsuit, brought by a coalition of small businesses in a dozen states, wasn't just about money. It was a constitutional showdown over the separation of powers. It's crucial to understand what this ruling doesn't affect. The old-school Trump tariffs, the Section 232 national security tariffs on steel and aluminum, and the Section 301 tariffs against China from his first term are based on different laws. They're safe, for now. This ruling specifically torpedoes his new, much broader 2025 tariff regime. Of course, this fight is far from over. The court delayed its own ruling until the 14th of October, giving the Trump administration a window to appeal to the Supreme Court. Trump has already taken to social media, blasting the decision as highly partisan and vowing victory. And to be fair, they have a shot. A 7-4 split in the appellate court shows there's a real legal debate here. The dissenting judges gave the administration a ready-made argument to take to the Supremes. Given that we're talking about trillions in global trade and a fundamental question of presidential power, the Supreme Court almost has to take this case. The board is set for a final winner-take-all legal battle that will define the economic landscape for years to come. While the lawyers sharpen their pencils, the rest of us are living with the economic consequences of these tariffs. It's a classic double-edged sword. On one side, you have the federal government's balance sheet. The Congressional Budget Office projects these tariffs will slash the federal deficit by a whopping $4 trillion over the next decade, $3.3 trillion from the tariffs themselves, and another $700 billion in saved interest payments. As of July, they'd already raked in $159 billion. That's the shiny number the administration waves around. But that $159 billion didn't just magically appear. It came directly from the pockets of American businesses and consumers. The Tax Foundation, a nonpartisan think tank, calculated that these tariffs represent the single largest tax increase in the United States since 1993. The government's gain is a direct loss for the private sector. It's a massive transfer of wealth. This leads to the other, much uglier side of the sword: the damage to the broader economy. The story the administration is selling is getting absolutely shredded by independent economic models. The numbers are not pretty. The Penn-Wharton budget model predicts the tariffs will cause a long-term drop in U.S. GDP of about 6% and a 5% hit to wages. That's catastrophic. Yale's budget lab is more conservative but still grim, forecasting a 0.9% drag on GDP in 2025 alone and a permanent 0.6% reduction in the size of the economy. The Tax Foundation chimes in, predicting a 0.9% long-term GDP loss and the elimination of the equivalent of 831,000 full-time jobs. You see the pattern. While the government celebrates its newfound cash cow, the engine of the actual economy is sputtering. We're all feeling it. Tariffs are, by their very nature, inflationary. One report suggested they could push U.S. inflation up by 0.5 percentage point. Yale's model estimates that the average American household is losing about $3,800 a year in purchasing power because of these tariffs. For businesses, especially the little guys, it's a nightmare. Small and medium-sized enterprises make up 97% of U.S. importers. They don't have the armies of lawyers and lobbyists to navigate this. They just get hit with rising costs and tangled supply chains. But perhaps the most toxic effect is uncertainty. When you have no idea what the rules of the game will be tomorrow, you don't invest, you don't hire, you wait. And when every business in the country is waiting, the entire economy grinds to a halt. Zooming out, the global picture is just as bleak. The IMF and the World Bank have been screaming that this escalating trade war is the single biggest risk to global growth. The tariffs are forcing a painful, expensive, and inefficient reorganization of global supply chains. Our trading partners aren't just sitting there taking it. China has gone full eye for an eye, and the EU is playing a shrewd game of negotiation backed by threats. The result is a slow fragmentation of the global economy, a world where political blocks matter more than economic sense. That's a more volatile and expensive world for everyone. What happens when the Supreme Court finally makes its call? The outcome will send us down one of three very different paths. Scenario A, the court upholds. Tariffs are illegal. This is the big one. Politically, it's a devastating defeat for the Trump administration. It reestablishes Congress as the boss on trade and taxation and severely curtails any future president's ability to wage a one-person trade war. Economically, this is a shock and awe event. The bad news for Uncle Sam is the Treasury could be on the hook to refund every single dollar collected over $159 billion and counting. The Justice Department itself warned this could cause financial ruin, threatening everything from Social Security to Medicare. It would be a fiscal earthquake. But for the rest of the economy, it would be like a massive, instantaneous tax cut. The price of imported goods would plummet overnight, and this would be a huge disinflationary wave, boosting household purchasing power and turbocharging consumer spending. All those negative GDP effects we just talked about, gone. The market would absolutely rip on this news. It's the ultimate risk-on signal. Scenario B, the court overturns. Tariffs are legal. This is the flip side. A huge political victory for Trump. It would cement a dramatic expansion of presidential power, essentially giving the White House a permanent economic weapon to be used in any declared emergency. The tariff becomes a standard tool. The economic consequences? Simple. You take all the negative effects we discussed, the drag on GDP, structural inflation, supply chain chaos, and you make them permanent. This becomes the new normal. Global companies would have to accept that high, unpredictable U.S. tariffs are a fact of life and accelerate their move away from reliance on the American market. This is a risk-off world where slow growth and high prices are the baseline. Scenario C, the legal limbo continues. This is the world we're living in right now. The government keeps collecting tariffs, but a giant legal question mark hangs over everything. The single biggest cost in this scenario is the uncertainty tax. For a business, uncertainty is poison. It's worse than high costs. You can plan for high costs, you can't plan for chaos. When you don't know if your key components will face a 25% tax next month, you don't build that new factory or hire those 50 new workers. You sit on your hands and wait. Economists have a term for this: real options theory. It basically says that when the future is foggy, the value of waiting for more information goes up. The rational choice is to delay. When millions of businesses make that same choice, the macroeconomy stagnates. It's an invisible tax that drains the economy of its vitality. This is the slow burn scenario, where the economy is bled dry not by a single blow, but by 1,000 cuts of indecision. How do we make money from this, or at least protect our capital? Your strategy needs to be dynamic, ready to pivot based on which of these scenarios unfolds. Let's drill down. The battle lines are clearly drawn. The stocks that get clobbered by tariffs become the biggest winners in scenario A. Automakers and parts suppliers. This industry has been choked by tariffs. A reversal would be pure rocket fuel for their margins. Retail and consumer goods. They've been squeezed by higher import costs and weaker consumers. This would be a massive tailwind. Tech and semiconductors. The global nature of their supply chains makes them incredibly vulnerable to trade wars. Relief here would unlock a huge valuation re-rating. Conversely, in scenario B, tariffs are legal, you want to be in the defensive bunkers. Utilities and healthcare. These sectors are domestically focused and largely immune to global trade flows. They are the classic safe havens. Some domestic manufacturing. A small number of U.S. companies, like certain steel producers who directly benefit from the protectionist wall, would do relatively well. Global U.S. megacaps with pricing power, companies that can pass on costs and have diverse revenue streams, will be far more resilient. The wild card, Trump-related crypto. A special mention for assets tied directly to the Trump brand, most notably the WLFI token from World Liberty Financial. These assets don't trade on fundamentals. They trade on narrative and the perceived strength of the Trump political machine. The Supreme Court's ruling will be seen as a direct referendum on Trump's power. If he loses scenario A, the narrative of the unstoppable winner takes a massive hit. This could trigger a panic sell-off in assets like WLFI as speculative hot money flees. If he wins, it's vindication. It reinforces the brand, electrifies his base, and could ignite a speculative frenzy in these politically linked tokens. For anyone dabbling in this space, understand you are not investing in a company. You are making a direct bet on a political outcome. Treat it as the high-risk gamble it is and manage your position size accordingly. So, there you have it. A constitutional crisis, an economic inflection point, and a generational investment opportunity all rolled into one. The stakes couldn't be higher. The key is to stay informed, understand the scenarios, and be ready to act decisively when the Supreme Court finally shows its hand. Stay safe and stay invested.